This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 23, 2026, and this is the New York pre-market. Now, let's get into it. The market is telling a bifurcated story. The S&P 500 is essentially standing still at $747.41, but look closer at the components. The Russell 2000 is flashing red at $293.79, down nearly 1%, while the Nasdaq 100 is shedding ground at $705.35. Meanwhile, utilities have surged over 2%. We are seeing a massive liquidity drain from growth into defense. Let's look at what's driving this rotation and where the cracks are forming. On the calendar for the next 48 hours, we have several earnings reports that could sharpen this divergence. Today, Albertsons reports Q1 earnings having already missed expectations, pre-market down over 16%. We also have Tesla reacting to a Needham hold reiteration, down 8% pre-market. And later, Lockheed Martin raises 2026 guidance. These aren't just corporate updates. They are stress tests for the defensive versus growth dichotomy we're seeing right now.
And for Tesla specifically, watching that pre-market level is critical. If it doesn't recover, it's a signal that the market has fully priced in the higher for longer rate environment killing growth multiples.
So let's break down the market overview first. The broad tape is anchored by SPY at $747.41, barely moving at minus 0.12%. But inside that index, we have diamonds at $521.47 holding flat, while IWM drops almost 1% and QQQ falls 0.5%. The VIX sat at 17.5 recently, showing low volatility, but that feels deceptive given the breadth weakness. Only 3 sectors, utilities, energy, and consumer staples, are green. 6 are red. How do we interpret this lackluster top-line movement? It's a classic news action divergence. The VIX at 17.5 screams complacency, but look at the sentiment scores for the movers. Tesla is carrying a heavy minus 0.75 bearish sentiment score across 8 articles. That negative sentiment isn't being absorbed. It's causing a minus 8.2% gap down. The market is ignoring the neutral to positive scores on megacaps like Goog, which has a plus 0.2 news score, and instead punishing the stock 5% on the AI infrastructure concerns. The crowd isn't waiting for good news anymore. They're fleeing execution risk.
And that fleeing capital has to land somewhere, which explains the technical structure we're seeing. Look at the Russell 2000. Price action at $293.79 is compressing tightly against the critical 5-day low of $291.64. In the last 4 sessions, IWM has closed at or near that low 3 times. That is a failed bid. It's not a dip. It's a structural break in the immediate uptrend channel. If we get a daily close below $291.64, we trigger mechanical stops. Meanwhile, SPY at $747.41 is just sitting in the lower quartile of its 10-day range, masking that weakness with stability.
Agreed, you're looking at the symptoms, I'm looking at the cause. The fundamental driver here isn't just liquidity draining small caps, it's the collapse of the AI infrastructure thesis. ST Microelectronics plunged 17.6% on a catastrophic Q3 revenue outlook miss. That is a direct contradiction of the bullish capex assumptions driving the tech sector. Compare that to Cleveland-Cliffs, which surged 11.8% on narrower losses and revenue growth. Investors are abandoning speculative capex bets for tangible industrial cash flows. The reason people held those small caps and tech stocks is fundamentally broken.
That fundamental break is exactly why the VIX at 17.5 is so dangerous. You have a flattening yield curve. The 10-year minus 2-year spread is compressed at plus 0.36 percentage points, with inflation still stuck at 3.46%. The market is mispricing the durability of these growth assets while ignoring the liquidity evaporation in the Russell 2000. That low VIX reading suggests the 17th 6% move in SDM was treated as an isolated incident, but it's a systemic warning. Once small caps fracture below $291.64, the stable large caps will face forced deleveraging, making those support zones irrelevant.
Let's drill down into the specific movers that are defining this sector rotation. First, let's talk about IWM, the iShares Russell 2000 ETF. It's at $293.79, down 93 basis points. Grid, you mentioned the $291.64 level. What does the chart tell us about the probability of a breakdown versus a bounce?
The chart tells us there is no bounce. We are seeing classic distribution characteristics. Volume is declining on the minor rallies and price is rejecting higher levels consistently. The 21-day moving average is turning down, and we are testing the July 17 low of $291.64. The probability-weighted outcome here leans heavily toward a breakdown. If we lose $291.64 on the close, the next structural support is significantly lower, likely opening the door to new multi-week lows. There is no accumulation pattern here. It's a bear flag forming in a downtrend.
Agreed, and that technical breakdown is fueled by the sentiment wrought in TSLA. You can't separate the index from the component that drives retail interest in small-cap beta. TSLA minus 0.75 sentiment score is contagious. When the high beta leader gets hammered on a hold rating, the sentiment contagion spreads to the entire small-cap complex. The crowd is not just scared. They are exiting positions, because the narrative of growth at any cost has evaporated.
And CIPHER note, the institutional flow data confirms this. We are seeing net outflows from high-growth equity funds and inflows into value and defensive strategies. The money managers aren't trained to catch the falling knife in small caps. They are raising cash or moving into yield. The SDM miss is the catalyst, but the structural shift is permanent unless earnings revise upward, which they haven't.
Now, let's pivot to the QQQ, the Nasdaq 100, currently at $705.35, down 51 basis points. This is where the AI narrative is cracking. QQQ is consolidating below the July 22 high of $709.65. How do we read this setup relative to the support at the July 20 close of $696.06?
It's a consolidation zone with thin air underneath. QQQ is trapped between $709.65 resistance and $696.06 support, a very narrow range that suggests indecision. But remember, SPY is flat while QQQ is down 0.5%. That means the weight of Apple and Microsoft is propping up the index while the broader tech exposure is weakening. Technically, $709.65 is becoming a ceiling. Every time price touches it, sellers step in. If we break below $696.06, we expose the July 20 low and the path of least resistance becomes vertical toward the lower Bollinger Bands. This isn't a consolidation, it's a coiling spring ready to snap down.
The sentiment profile reinforces the technical weakness. Look at the divergence between MSFT and GOOG. MSFT has a plus 0.56 sentiment score, reflecting software resilience. GOOG has a plus 0.2 score, yet it's down 5%. Why? Because the market is punting on the infrastructure costs associated with AI data centers. The sentiment is shifting from buy the hype to show me the margins. The crowd is realizing that the CAPEX spend is eating into profits faster than anticipated. That negative surprise is what's capping the QQQ upside, not technicals.
Which brings us back to the risk. You guys are focused on $709 and $696, but the real risk is the correlation breakdown. If the 10-year yield ticks up even slightly, given the flattened curve, these duration-sensitive names get crushed. The VIX at 17.5 assumes everything goes right. One bad inflation print, or one more hawkish Fed comment, and that volatility compressions explodes. We are playing with fire in a dry forest.
Let's look at the winners of this chaos. The utilities sector, the Utilities Select Sector SBDR Fund. It's up 2.25% to $45.93, leading the week with a 1.57% gain. Why are capital flowing here?
It's a search for yield in a high-rate environment. With CPI at 3.46% and the Fed funds rate at 3.63%, utilities offer a bond-like yield with equity upside potential. Plus, the regulatory environment for utilities is stable compared to the volatile earnings cycles of semiconductors. The fund flows are clearly rotating out of consumer discretionary and into these defensive, regulated monopolies. It's safe money. LMT and RTX are also benefiting from this same logic, government-backed certainty in an uncertain market.
Technically, the utilities sector is in a clear uptrend channel. It's making higher highs and higher lows, decoupling completely from the broader market drag. The relative strength line against the S&P 500 is hitting new all-time highs. This is the textbook definition of a defensive leadership role. Money is parking here because it has nowhere else to go safely. The chart is pristine, unlike the messy breakdowns in QQQ and IWM.
It's also a fear gauge. When the utilities sector leads, it usually means investors expect harder times ahead. The flight to quality trade is active. The sentiment around utilities is overwhelmingly positive, with low volatility expectations. Retail is moving in, chasing the yield, which further fuels the technical breakout. It's a self-fulfilling prophecy of safety. Finally, let's touch on the energy sector, the Energy Select Sector SPDR Fund. Up 1.20% to $59.20. We see the same pattern, rotation into value and commodities.
Energy is benefiting from both geopolitical tension and the general dislike of tech valuations. Oil prices are supporting the sector, and unlike AI infrastructure, oil cash flows are immediate and tangible. The divergence between the energy sectors, plus 4.78% weak, and communication services is minus 3.69% weak, is the most significant metric in the market right now. It proves that capital is leaving risk-on assets for hard assets.
But don't get comfortable. Energy is also sensitive to global growth fears. If this liquidity drain turns into a recessionary shock, energy will eventually fall too. Right now, it's the cleanest shirt in the laundry, but the wash cycle is coming. Monitor the crude futures. If oil breaks key support, the energy sector joins the party.
Let's wrap up with a final synthesis. We have a market where SPY is flat, but the internals are screaming. IWM is testing a critical breakdown level at $291.64. QQQ is capping out at $709.65 amid AI narrative cracks, and capital is flooding into the utilities sector and the energy sector for safety. Apex tie this together.
We are seeing a structural break in sentiment, not just a technical correction. Grid flagged the fragility of the $291.64 support in IWM, and CIPHER confirmed that the fundamental thesis for holding those assets, the AI growth narrative, is collapsing after the SDM miss. Pulse highlighted that the bearish sentiment on TSLA is a leading indicator for high beta exhaustion, while SPECTER warned that the low VIX at 17.5 is masking a yield curve stress that could accelerate any downside move. The market is no longer rewarding innovation, it's rewarding survival. The rotation into the utilities sector and the energy sector isn't a temporary trade, it's a repricing of risk in a higher for longer rate environment.
So the takeaway is clear. The broad market mask is slipping. The S&P 500 looks stable, but the Russell 2000 is teetering on a breakdown, and tech is facing a fundamental credibility crisis. Investors are fleeing to utilities and energy. Keep an eye on the IWM close relative to $291.64 and the reaction of TSLA to that pre-market sentiment. That will set the tone for tomorrow. Thanks for listening to ShadowQuant Equities Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.